Good afternoon or good morning or good evening, whenever you're listening to this broadcast. This is the podcast coming from United Capital Management and the Redneck Yacht Fund. I'm here today I need to introduce myself because this is going to be sent out to a lot of people that don't know who I am because of a new venture. My partner, Adan Ibarra, and Adam is a CPA, and we are partnering on the purchase of a couple of CPA firms and installing our wealth management services into his entity. Adam is not only a CPA, he's a JD, and hopefully come the end of February, he will officially pass the bar and be a little more official than just a JD, right?
That's the goal, or else it's been 3.5 years to have a very expensive piece of paper on the wall.
You want to mention briefly your other certifications in education?
Yes, that's my fourth degree. I have a BBA in finance, BBA in accounting, a master's in advanced data analytics, and now a JD. Ever since I was a small kid, I always wanted to have a doctorate, but at this age, being practical, a doctorate in finance or doctorate in accounting would just, elevate you to academia, which I'm not trying to go into academia. So getting a Juris Doctorate just made so much sense because I have so many clients that are older. It's typically the older clients that have the need for estate planning. So I knew that the JD and ultimately being an attorney would kind of help take my CPA firm to the next level. And now that you and I are doing business together, I just see even so many more opportunities on advanced tax planning, business clients, just et cetera, et cetera. So it's going to be, I think, a powerful portion of our business offering going forward.
Adam and I were introduced by a friend of mine and a person who we operated out of his office in Fort Worth in the process of buying that firm out, which we'll make that public later. But, we had started pushing for this here a couple of years ago in regards to bringing in tax professionals within our offerings, at United Capital Management in our industry, where we have to use disclaimers that we don't give tax advice, see your CPA, but we'd make a lot of suggestions and recommendations that we knew were of a tax advantage. And a lot of times those wouldn't get implemented because we lack tax preparers in this country. And in fact, there's such a shortage that there's still a lot of CPAs and tax preparers grinding it out from literally 1st of January to nearly to October 15th. Filing extension has become a normal thing because these accountants just can't get the product out, and I'm focusing on the preparation, so they don't have time to do the tax planning. This is why we're very interested in this partnership with Adam. He's already brought me a slew of things that I can do to not just reduce my taxes in the present and in the future, but potentially amend some returns and get some money back. Adam, let's just start rattling off some things that you're most excited about and strategies that you're looking for with your business owners in particular.
So even my firm falls into a position where clients come to me, they gripe about their CPA, that their CPA isn't helping them, and they want more tax planning. And in back of my mind, I'm thinking I'm going to be the same type of firm to you. And you're probably thinking, Adam, why are you saying that? I'm hoping that by what we're doing, going deeper with the clients between being able to help them with their wealth, being able to help them with their, taxes, being able to help them with estate planning, I'd much rather go deeper with a client and have less volume so we can actually provide what the clients truly want. And it's that integrated professional that knows everything about it. So finding you was a godsend because I've been looking for you for the last year and a half. So from the client's perspective, I'm going to give you some real life stories. He's not a client, but he was one of my insurance guys, sent him to me, pays $200,000 in taxes, and he owns a $5 million building. He didn't know a cost segregation study. His CPA never told it to him. So I'm a little different from most CPAs in that I specialize in real estate. I've been involved with UPREIT transactions, drop and swaps, multiple integrated 1031 exchanges, even have done deferred self-trust as part of a real estate transaction, which is different from a delegatory trust.
I'm going to ask another. If you're business owner, commercial real estate, or willing to own real estate, there is opportunity with the cost segregation studies is what you're focused on. I don't think you got into accelerated depreciation, but that's where you're headed with that.
Correct. There are some intricacies whether or not you own real estate and you're passive or active. So don't get me wrong, there isn't a silver bullet, but that's where, active tax planning, where we come in and we structure around those nuances of the tax code. So being prepared to utilize an advanced strategy, knowing what the rules of the game are, we just make sure that, we check all the boxes and that strategy works for the client. So I give a presentation typically once or twice a year to different groups. I get invited to speak, and the strategies that I'm always touting are cost segregation studies, Airbnbs, renewable energy, deferred self trust, being considered a real estate professional. Those are very effective strategies. And depending on the client, if they're a business owner, well, business owners have other pieces of the tax code that benefit them. But I always try to tell my business owners, don't shoot yourself in the foot. You don't want to look for every expense possible, because then you're making your business look unprofitable and you hurt yourself for growth. As a business owner, OPM other people's money, a business owner wants attractive bank financing. But if they write off everything under the sun, they're just hurting themselves to take their business to the next level. So you got to be smart. You got to use the tax code to your benefit and not just try to write off everything for the sake of lowering your taxable income.
Right. And that'll come back and bite you in the long run too.
It will.
You want to talk about solar?
Yes. So I'm not sure if I told you this. So I actually got in solar in 2010. It was one of the reasons why I wanted to go back to school and get my CPA credentials. I used to go around to CPA firms and educate CPA partners on how it would benefit their clients. What I didn't know back then is how busy CPA firms were, and the fact that they don't have enough time to go educate their clients and kind of try to help their clients get into these strategies. But here's the benefit of solar. There's a term called tax equity investment, which means that you make an investment into a partnership and the partnership allocates you credits and deductions. The deductions are the depreciation from the solar. Then you have different, very complex structures. You have inverted lease, partnership flips, you have sell lease backs. Those are the three common. And for the sake of this call, I'll try to keep things simple. But if you look at Amazon, if you look at Google, and they tout that they're investing green and going green on their data centers, they're getting the PR benefit of the renewable energy, but they're really doing it for tax planning. CFOs of those companies that are making incredible amounts of money, well, whether they decrease operating expenses or decrease tax expenses, profit is profit is profit. So the CFOs of those type of companies are looking at ways of decreasing their tax expense, which ultimately means more cash on the balance sheet, which means, they can then go out and do other acquisitions. They can go ahead and do share buybacks, et cetera, et cetera. So renewable energy, and Biden, depending on who we're listening, I'm not trying to make this political. I was for the Green New Deal. I was. And because I know that energy going forward, we need low cost electricity in order to make our business owners be able to have profitable businesses. We don't want expensive electricity the way it is in California that's 40 cents. Texas has always been a very good state because we've had a lot of abundant power. So I think the Green New Bill was needed because it spurs more economic business opportunities and it creates tax planning opportunities.
Any other tax strategies you want to visit about?
Well, you can mix and match tax strategies as well. Buying a piece of real estate and then putting a solar energy project on top of it. You're getting a double whammy right there. Clients that are, that have a day job, but their spouse doesn't work. One of the strategies is to make the spouse the real estate professional. Well, now you can take that bonus depreciation from those cost segregation studies against, the spouse that has that high earning W-2 job. And everyone knows the tax code isn't really geared towards W-2 wage earners. It's geared to self-employed. So I love coming in here when I have a couple, and the clients that typically come to me are the clients that have, Schedule E rental property income and they own 2, 3, or 4. Those are the clients that I can help a whole lot more than just the client that has the W-2 income.
When you buy a tax book and collectively the clients are paying $200 million in taxes collectively, Okay. I don't know. Is that a reasonable number to use as an example?
So 2 years ago, I looked at the amount of taxes across my clients because we can run a report. My clients were paying all in over $150 million a year in tax.
Okay, so to note, these are practices that you acquired. They weren't your long-term clients. Therefore, you're looking at a fresh set of clients paying 150 million in taxes. And what do you think that number should be? Because I'm going to make this statement. I've always thought, if you read deep enough into the tax code, take advantage of all of the opportunity that's presented for, quite frankly, somewhat entrepreneurs or people willing to make investments in real estates and other things. There's a way to never pay taxes or at least reduce them significantly. So if you acquire a book of business and they're paying 150 million collectively, you speculate on a number that when all these strategies are put in place, what the number would be after. Putting you on the spot here.
It's a good question because the problem is when you get to the advanced tax planning, it's a financial planning conversation and a tax planning because to invest in some of these higher strategies, like I just mentioned, renewable energy takes cash. To go buy a real estate property, it takes cash. And fortunately, I have some clients, and this is a true story, husband and wife, 320,000 a year. And I asked them how much they have. And they said, Adam, we have nothing. And I'm like, why? And they started telling me, well, we have 3 kids in private school. We take 2 vacations a year. We have 2 cars, we have a second home. So they're living on every bit of the 320 where as much as they want a tax plan, they don't have the capital to do so. And when you get into those advanced strategies, it takes money to make money. It takes money to save money.
In a perfect world, I think you could reduce 2/3 of those taxes or more. But then you get into coaching people like that in a place where they can take advantage of it. 50% of this population pays no taxes because of income, but then once you reach a threshold of a certain amount of wealth and cash flow, then you don't pay taxes again. It's kind of all the people in the middle paying the bills. So,
You are so right about that because the people that can afford the me's of the world and even the bigger firms that have multiple me's on staff, they're not paying taxes. And they have the means to go out and invest in these strategies and they don't have to go find them. They have a team of people that go identify the investments, underwrite them, and just tell them, hey, cut a check and you're done.
So
So
you either have to have the capital or have access to capital. For a good banking relationship is an advantage. So let's talk about Roth IRAs for a minute, or conversion Roths. Do you have any opinion on those, or I'm gonna state my opinion.
this is actually going to be a fun conversation. I just met with a brand new client yesterday. We moved here from California, met her in our Grapevine office, and her financial advisor had her put 50,000 over into a Roth. She's 62, and she paid 22% tax on that $50,000 conversion. I'm of the opinion that a dollar today is worth more than a dollar tomorrow. I told her if it was me, I wouldn't have done it. You're in a 22% bracket. Why do you want 1/5 of your money going to Uncle Sam? Keep that 1/5 of your money. Let it grow for the next decade. And I said, in the next decade, then we'll tax plan there and we can do like a qualified longevity annuity contract as a strategy. But I'm like, why do you want to give Uncle Sam your money today that's going to be worth less tomorrow when it could be working for you today? Now, I told her, I said, if you're in a 10%, I would be giving you a different answer. But you're in you're 22 cents on the dollar to basically just do a Roth. So that financial planner said, so she didn't have to worry about R&Ds. I said, we can plan in the future. At what threshold do you think a Roth doesn't make sense? And I'm going to really love your answer. And what would you have told the client that I met yesterday?
Well, those people that can fund it annually, whether an individual or a couple, just a regular Roth is a great thing if they're eligible, right? When it comes to, a retired couple that they both approximately reach that age of 73 or 75, depending on what their RMD is projected to be, reasonably, that can be dealt with down the road. And so, yeah, I've seen Roth conversions used way too aggressively. So I can agree with you. There's a fancy term, being you went to law school, when two answers are both right and both wrong. On the flip side of it, But we are in a technology revolution like we've never been in. Uh, Technology will most likely change our lives in the next 5 years more than all of history. It's 25 years from now. I'm not sure that every job as you know it today most likely will be replaced by AI and robotics. And not a day goes by when I look at sometimes an 80-year-old widower, say, hey, you've got enough money, Mrs. Whoever, you know, to make it till age 110. And we're most likely investing for your grandkids. And we need to own those companies that are going to make it very hard for your grandkids and their kids to find jobs. But when we as I've told you, talk about United Capital Management just a little bit. We New York and other places, and we speed date with CEOs of privately held companies and publicly held companies. In fact, we're one of our highest conviction companies. We're going to go visit it. We're going to have boots on the ground mid-August to get a tour of the facility. And we know that if this company is successful, by the way, we're not giving any investment advice today, but we believe that they will someday trade between, 30 times and 100 times where they are today. And if you buy the right companies in this technology revolution, and we can't guarantee we're going to buy the right ones, life doesn't always work out like we think it's going to. But if we buy the right technology companies, a 60-year-old sitting on $1 million IRA might have several $1 million by the age of 75, and where their RMDs are potentially more than they've ever made in their life. Their RMD may be more than, and we actually have a lot of those where their required minimum distribution is more than what they ever made in their career. And so that's why we've become probably a little more aggressive with Roth conversions since 2016, as opposed to prior. We'll look back as that kind of being a dead period in our history of advancement in technology. And back when the World Wide Web hit and the internet and all of that, early 90s, we saw explosive growth. And I think what's ahead of us, barring any major economic events that have a deep effect, we're going to experience a lot of expansion there. That'd be my case for Roth conversions. So when you hit 75, you're 25 to 50% of your retirement assets are in a Roth to keep that RMD from compounding into something significant. And of course, that's why when we do a Roth conversion or somebody has just established a Roth IRA, we have some incredibly large Roth IRAs. And it doesn't seem like those have been around that long, but you definitely want to own your growth companies and your disruptive technology companies inside that Roth. Now, what blows me away, and it angered me very much, but I've seen basically Roth IRAs sitting in bank CDs. No point in owning a Roth when it's in a bank CD today, but to convert something like that, yeah. So it depends on what they own. Okay,
Let me ask.
obviously, if they bought, I'll say one more thing. If they bought Tesla's IPO in 2010, I believe, I don't know if I have the year right, but if that's the year it was, obviously to have owned it in a Roth IRA, that would be a bigger tax advantage than to own it inside a traditional IRA. So that'd be an example.
So that woman that I met with yesterday, she did $50,000, so 22%. Let's just call it 20%. So 10,000 went to Uncle Sam. I have two questions for you. One, at what marginal tax rate would you say, heck no, don't do it? You might say, Adam, 22%, do it all day long. You might say, Adam, I agree with you, 22% is too high. Follow-up question, wouldn't it be better for her not to pay that 10,000 Uncle Sam, put that 10,000 into growth stock? That if you could have got her 30x return on that $10,000, why the hell does she even give a crap about the taxes 10 years from now if you got her 30x return on 10,000 bucks that she just gave to Uncle Sam?
So just thinking out loud here, tell me if I get this wrong. If they marry couples RMDs today, I'm just throwing out a hypothetical number. You'll know it being in the business, but if their RMDs are 60,000, that's pretty minimal damage. But if the RMD is 120,000, when it could have been 60, that's a lot of difference down the road when they're no longer earning an income and assumably retired. But But where I'm also going to go with this is you do these Roth conversions. And if you do it with a business owner where you can go back and apply the segregation study, buy solar, you combine it with that, then quite frankly, a lot of your strategies, we're probably going to run into a lot of people that your strategies are going to offset that conversion, potentially.
So I think we're saying the same thing. It's just I'm quantifying it because to me at 22%, I'm like, heck no, don't do it. But if she would have been in a 12% bracket, then I think she should do it. So to me, the cutoff was that 22%. That's where I'm like, don't do it. Because again, if you have another client today that's in a 24% marginal bracket, well, I know it's only 2% higher, but I'm of the opinion to keep that 24% and have that grow for the next 10 years. And then, I'm sure the government will come out with other, tax strategies. For example, renewable energy. Well, they can invest in renewable energy, have a tax credit, and that's how they pay their tax bill with a renewable energy strategy. So I'm like, hey, we can tax plan around the tax bill, but I'm of the opinion, keep your money and have your money work for you today because a dollar today is worth more than a dollar tomorrow.
The bottom line, what matters here is you care about your clients and you're going to go around that strategy circle to try to determine the right strategy for that particular need. I'm going to flip to the other side. We've got clients that have had some tremendous growth because of this expansion in technology. And that R&D check, sometimes part of it, sometimes all of it goes to churches and charities. So it becomes a non-issue. Okay. And then, of course, we've got some clients that the asset that they're going to leave that church or charity is that retirement account. And that in a very perfect world, your IRA becomes your kind of like a foundation to gift out of, essentially. It's where you're benevolent. Okay, that's what I'm looking for. So all boils down to the circumstances of the client. But yeah, if you're talking about somebody that most likely is going to have nearly, and there's a lot of Americans out there, they own their house and their IRA, and that's about all they have. Okay, their retirement savings, there's a good chance that their RMDs are not large enough on top of their Social Security to be of a tax concern at all at the required minimum distribution age. And if that was this particular person's circumstance, then it was probably very much a bad suggestion or disservice. And so, I've seen a lot of financial advisors use it as just a selling point, something just to bait and retain a client. And I've probably seen more bad conversions than I've seen good, at least outside of our organization. Together, we can enrich lives more than what we can independent of one another. And that's kind of what it's all about. I've noticed you have a real personal relationship with your clients and you care about them a lot and want to reduce their taxes. And everybody's game for that.
Here's something I want to ask you because it's stacking strategies. I know you're familiar with qualified opportunity zones, but for the people that are going to listen to this, do you want to give an overview of a qualified opportunity zones?
Yeah, absolutely. Go ahead.
So again, the government creates programs in order to spur job creation. One of those is qualified opportunity zones. Basically, you look at different census tracts across the country. The program is designed to spur money into census tracts that are typically depressed economically. And what the government will do, and it was renewed under the big beautiful bill, that capital gains, if you just take the capital gains tax, not the entire proceeds from when you sell your stock, but just the tax. So if you sold $1 million in stock and you had a $200,000 tax liability, you would only take that 200,000. If you took that 200,000 and you put it in a qualified opportunity zone, you can defer that tax as long as it's in there. And if you kept it in there longer than 10 years, it actually becomes tax free. You keep that entire $200,000. But the beautiful part of stacking the strategy is if that went into qualified opportunity zone that happened to be a multifamily project, for example, well, now you get the depreciation from that multifamily project as well. So think about what you just did from a tax planning perspective. You've now basically your capital gains tax is now staying in your family's financial net worth. It's not going to Uncle Sam. And you're also now getting the cost segregation study, which is accelerated depreciation from that apartment complex. So you just basically got a 2-for-1 on that tax strategy. It's identifying the qualified opportunity zone. It's making sure it's a good investment. It's putting together perspectives for the client. And I think what we're going to be doing for our clients going forward, because we're just getting started, is who we are 6 months from now is not who we're going to be 3 years from now. It's just not. And
Our
it's a whole nother world out
there. Our 3 properties that you said in Salina, Kansas are called.
Did you make an investment in them because of that, or just happened to be the case?
Happened to be the case. This was the property that fit us the most, for sure. So it was a secondary issue there, not a primary issue. It's great talking to you today, and I'll be back down in Fort Worth here in a little over a week, and we'll keep on enriching lives. So thank you. Have a good evening.
Thank you, sir.